They just weaponized geography. Today, Tuesday, January 20th, 2026, the United States announced a 10% tariff on precious metals refined outside North America. They are calling it the Greenland Security Initiative. To the average investor, this sounds like routine trade policy. To the insider, this is the LBMA's death certificate. Shock value, 10% tariffs on foreign refined silver. The London Bullion Market Association, the entity that controls 70% of global silver refining, has been cut off from the largest physical market on Earth. The premium on American Silver Eagles just jumped from $6 to $14 overnight. Insider framing. To the casual observer, this is about Greenland. To those who understand the silver market, this is about breaking the paper price manipulation system that has controlled precious metals for 50 years. This is the beginning of the end for the LBMA. The White House issued Executive Order 1/1/27 at 6:47 a.m. Eastern Time. Effective immediately, any precious metals refined in facilities outside the United States, Canada, Mexico, and Greenland face a 10% import tariff. The official justification? National security and domestic refining capacity. The target? Every single refinery in London, Zurich, and Perth. Why now? Because the LBMA just reported that allocated silver inventories dropped to 927 million ounces, the lowest level since 2019. Because Shanghai has been trading at a 2.40 premium for 6 consecutive weeks. Because the spread between paper silver and physical delivery has never been wider. They needed to act before the arbitrage window exploded the entire fractional reserve system. The villain here is not who you think. Yes, the Treasury Department drafted this order. Yes, it was signed by the president. But the real architects? The bullion banks holding 480 million ounces of paper short positions on the COMEX. They are drowning, and this tariff is their life raft, bought with your tax dollars and disguised as patriotism. Let me translate this into plain English. For decades, London has refined global silver, set the price through the LBMA fixing, and shipped physical metal to wherever paper contracts demanded delivery. The United States imports roughly 6,200 metric tons of refined silver annually, most of it from LBMA-approved refiners. This tariff just added $2.80 per ounce to every bar coming from London. It makes American refineries instantly competitive. It traps silver inside geographic borders. It fragments the global market. It destroys the arbitrage mechanism that keeps prices aligned. Why did they do this? Because the paper market was about to collapse under the weight of its own fraud, and they needed to create artificial walls to prevent the flood. This is the same weapon they used in 1933 when Roosevelt banned gold ownership. It is the same weapon they used in 1971 when Nixon closed the gold window. It is the same weapon they used in 2008 when they allowed Lehman to fail, but bailed out JP Morgan. When the system cannot meet its obligations, it changes the rules. When price discovery threatens to expose insolvency, it erects barriers. This is not new. This is the playbook. And if you have been paying attention, you saw this coming. We warned on December 3rd that geographic fragmentation was the next tool in their arsenal. We said the premium divergence between continents would force a policy response. The data told us. The vault withdrawals told us. The Shanghai premium told us. And now, here it is. Silver futures on the COMEX opened down 3.2% at 28.73. Spot silver in London dropped to 28.41. But American Silver Eagles, they are trading at $42.50 at major dealers. The Perth Mint quoted $41.20 for kangaroos. The U.S. Mint suspended sales at 10:15 a.m., citing inventory reconciliation. The spread between paper and physical just went vertical. CNBC is calling this a protectionist trade policy. Bloomberg says it is about Greenland's mineral rights. Reuters quotes Treasury officials saying this will strengthen domestic refining infrastructure. They want you to believe this is about jobs, about security, about fair trade. This is about survival. The LBMA has been running a fractional reserve scam for decades, selling the same ounce of silver to 50 different buyers through unallocated accounts. When those buyers started asking for delivery, the game was over. This tariff does not protect American jobs. It protects American banks from a $180 billion derivatives implosion. It buys them time. And it just made your physical silver significantly more valuable. The LBMA reported 927 million ounces of allocated silver as of January 15th. That is down from 1.04 billion ounces in November. That is 113 million ounces withdrawn in 8 weeks. At the current pace, allocated inventories will reach critical levels by March. The Royal Canadian Mint reported a 340% increase in silver maple leaf orders in the past 30 days. The Perth Mint has a 16-week backlog. Asahi Refining in Utah increased hiring by 60% in Q4 2025. This withdrawal pattern is not random profit-taking. It is coordinated. It is industrial. The ounces leaving London are not being sold. They are being moved. Moved to Shanghai, moved to sovereign vaults, moved to jurisdictions where property rights are enforceable and fractional reserve banking cannot reach. The increase in domestic refining capacity is not preparation for future demand. It is preparation for a supply chain that no longer includes London. This means the global silver market is already fragmenting before the tariff was even announced. It proves that major players have known this was coming. It validates the thesis that LBMA inventories are fictional, that the paper market is a facade, and that we are watching the managed demolition of a 70-year price suppression scheme. 8 of the 12 largest bullion banks are net short silver by a combined 480 million ounces on paper contracts. Those contracts promise delivery at spot price plus a small premium. But physical silver is already trading $8 to $14 above spot for retail coins. If industrial buyers start demanding delivery on allocated contracts at these discounts, the banks cannot fulfill. They do not have the metal. They never had the metal. They have been selling IOUs backed by the assumption that most buyers will settle in cash. The tariff accomplishes 3 objectives. First, it creates artificial price divergence between regions, making arbitrage difficult and preventing unified price discovery. Second, it incentivizes American buyers to accept COMEX delivery rather than importing from London, reducing delivery pressure on overseas vaults. Third, it gives cover for force majeure clauses and cash settlement by claiming supply chain disruptions caused by tariffs. This is financial engineering disguised as trade policy. Because industrial demand is inelastic. Solar panel manufacturers do not care if silver costs $30 or $50, they need it to function. Because Chinese and Indian buyers will pay the premium and continue draining Western vaults. Because physical silver holders are not speculators who can be shaken out with margin hikes or rule changes. They are long-term accumulators who understand the end game. The tariff can slow the collapse. It cannot stop it. As of 11:30 a.m. Eastern, spot silver in New York is $28.73. Spot silver in London is $28.41. Spot silver on the Shanghai Gold Exchange is $31.18. American Silver Eagles are being quoted at $42.50. That is a $13.77 spread between paper and the most liquid physical product. That is a $2.77 spread between New York and Shanghai before the tariff. After the tariff, importing Shanghai silver to New York would cost $34.30 per ounce, eliminating the arbitrage entirely. Before this tariff, if silver sold for $28 in New York and $31 in Shanghai, traders could buy COMEX contracts, take delivery, ship to China, and pocket $3 per ounce minus shipping costs. This kept global prices aligned. The tariff just added a $2.80 wall to that equation. Now the spread can widen to $5, $7, $10 per ounce, and arbitrage becomes unprofitable. Markets fragment. Price discovery dies. Despite the tariff, silver will still flow west to east. Why? Because Eastern buyers are not trading. They are accumulating. Chinese buyers do not care about the premium. They are converting dollars into hard assets before the dollar loses reserve status. Indian buyers are buying for weddings, for jewelry, for wealth storage that has persisted for 3,000 years. The tariff does not stop this flow. It just makes the West poorer as the metal drains. The Shanghai premium creates a price floor. If COMEX silver drops below $30, arbitrage traders will drain every available ounce and ship it to Asia until the price rises. The tariff weakens this floor for American buyers, but it is still there. It still prevents silver from collapsing back to $20. It still proves that real demand is far above the paper price. The executive order cites Section 232 of the Trade Expansion Act, the national security provision. The official White House statement claims this will protect critical mineral refining capacity and ensure supply chain resilience in times of crisis. The Commerce Department has been tasked with developing a strategic silver reserve by Q3 2026. The Treasury has authorized $4.7 billion for domestic refining facility expansion. They are framing this as infrastructure investment, as job creation, as protecting America from dependence on foreign refineries. They are invoking Greenland's mineral wealth, undeveloped silver deposits that will not produce meaningful ounces for a decade, as justification for immediate tariffs. What this actually means? We have run out of silver. The LBMA cannot deliver on its obligations. Foreign refineries cannot supply our industrial demand. We are creating legal cover to prevent delivery defaults and bank failures. The strategic reserve is an admission that current inventories are inadequate. The $4.7 billion is not investment. It is damage control. The Greenland angle is misdirection. This is Stage 3 empire behavior. Stage 1 is denial. Stage 2 is manipulation through margin hikes and price suppression. Stage 3 is geographic protectionism and resource nationalism. Stage 4 is confiscation. We are watching the erosion of the global monetary system in real time, and silver, industrial, monetary, irreplaceable silver, is the canary in the coal mine. First Solar just locked in a 3-year supply contract with Sunshine Minting in Nevada. Tesla's Gigafactory battery production requires 47 ounces of silver per megawatt hour of storage capacity. Lockheed Martin's hypersonic missile program uses 18 ounces per unit. Raytheon's guidance systems require silver-coated ceramics that cannot be substituted. The Department of Defense purchased 2.3 million ounces of silver in Q4 2025 through defense contractors. These buyers cannot function without silver. There is no substitute for silver's electrical conductivity in solar panels. There is no substitute for silver in missile electronics. There is no alternative for silver in medical devices, 5G infrastructure, and electric vehicle charging systems. Industrial demand is growing at 8% annually, while mine supply is flat. They are not waiting for dips. They are not trading the volatility. First Solar's CEO said in their Q4 earnings call that they are willing to pay whatever is necessary to secure supply. Military contractors do not care about premiums. They care about contract fulfillment. These buyers are taking physical delivery, building private inventories, and signing long-term contracts at prices $6 to $10 above spot. They are price insensitive. Physical buyers cannot be margin called. They cannot be forced to sell with rule changes. They do not care about COMEX delivery deadlines or LBMA fixing prices. They need the metal, and they will outlast every paper short position on the board. The tariff does not reduce their demand. It increases their urgency to secure domestic supply before the next restriction. But the tariff is not the only sign of panic. This brings us to the most important question. What happens when the LBMA cannot fulfill its allocated contracts? The verdict is clear. The era of globally fungible silver is over. The LBMA-centered pricing system that has controlled this market since 1987 is dying. The tariff is not the cause, it is the symptom. And for those who hold physical silver, this is the moment everything changes. If you are holding physical silver, realize that you are now holding an asset in a fragmented market where premiums are becoming permanent. The $14 premium on American Silver Eagles is not temporary volatility, it is the new baseline. Your stack just appreciated not because the dollar price moved, but because the metal itself became regionally scarce. If you are considering buying, understand that the window is closing faster than expected. The tariff accelerates every trend we have been tracking. It makes domestic supply more valuable. It makes foreign supply more expensive. It separates those who have metal from those who have paper claims. The decision is now time sensitive. If you are skeptical, ask yourself why a government would implement a 10% tariff on an asset that has been freely traded for decades. Ask why premiums are spiking while spot prices are flat. Ask why mints are suspending sales during a supposed price correction. The data is there, the pattern is clear. The only question is whether you will act on it. Do not sell your physical metal to chase paper profits. Do not assume the premium will shrink back to normal. Do not wait for lower prices that may never come. Do not trust allocated accounts at institutions that cannot show you the metal. Do not believe that supply will increase when the largest refiners on Earth just got cut off from the largest market. Rule number 1, hold your physical silver. The tariff proves the system is fragmenting. Ounces held in your possession cannot be hypothecated, rehypothecated, or cash settled. Rule number 2, understand the premium is the price. Spot price is a fictional benchmark created by paper contracts. The premium is what real buyers actually pay. As markets fragment, the premium becomes the true measure of value. Rule number 3, watch for force majeure. If LBMA inventories continue dropping at the current rate, we will see delivery failures by Q2. When that happens, allocated account holders will be offered cash settlement. That is the end game. Be ready. Rule number 4, diversify your metal sources. Do not rely on a single dealer or mint. As supply tightens, some will prioritize certain customers. Build relationships now. Secure supply chains now. Rule number 5, ignore the volatility in paper markets. Your physical silver does not change value because a futures contract moved 3%. The ounce in your hand is the same ounce it was yesterday. Price discovery is moving from paper to physical. That transition will be chaotic. Your metal is your anchor. You have held through the 2023 bank failures. You have held through the COMEX margin hikes. You have held while the media called silver a barbarous relic and told you to buy tech stocks. You were right. They were wrong. This tariff is proof that the physical silver shortage is real. It is proof that the paper market is losing control. It is proof that governments are resorting to geographic protectionism because market mechanisms have failed. You saw this coming. You positioned accordingly. You will be rewarded. This is the year the great repricing accelerates. This is the quarter when fragmentation becomes permanent. This is the month when the average investor realizes that their brokerage silver shares are not the same as metal in hand. You are early, you are positioned, you are ready. Keep stacking, stay vigilant, watch the spreads. And remember, when they change the rules, it means they have already lost. The question is not if the system breaks. The question is how much metal you will hold when it does.